you have been keeping your eyes on the finance world, you would have realized that 2022 has been in stark contrast to year 2021, when the financial markets were touching new heights with each passing day. Since the beginning of this year, a multitude of factors, including war, supply chain issues, inflation, interest rate hikes, and consequent recession, have kept the world of finance on its toes. And now, more recently, the troubles with one of the leading investment banks, Credit Suisse, are feared to spill over into a full-blown financial crisis. Are these fears well-founded or exaggerated? Welcome to Upsurge, where we make finance fun, interesting, and easy, as it should be. In this video, we will check out what is up with Credit Suisse and if its distress will really blow over into a global financial crisis. To know more about that, you might consider giving us a subscribe so that the YouTube algorithm works in our favor. Credit Suisse is one of the largest global investment banks based in Switzerland. And as you might know, apart from its beautiful landscape, Switzerland is famous for financial secrecy and privacy, which makes it a paradise for high net worth individuals and institutions that want to keep their money and make more of it without getting scrutinized by the government. And that's where Credit Suisse comes in. The investment banks like Credit Suisse manage the wealth of ultra-rich individuals, families, trusts, and institutions. In simple terms, this means that Credit Suisse takes money from them and invests in a way to make the best possible returns. Well, that sounds like a pretty good business, right? So what's the issue? After the 2008 global financial crisis, people became increasingly wary about their money, and the investment banks had to entice them to stay as a client by offering attractive returns. However, this meant taking more risks too, which didn't pan out too well for Credit Suisse. If you observe the share price trend, Credit Suisse has been losing its market value since the 2008 global financial crisis. The share price has witnessed almost a consistent decline, especially in recent times. In the current calendar year 2022 itself, its share have dropped about 60%, with its market capitalization slipping to nearly $11 billion, which is lower than Indian banks like HDFC Bank, ICICI Bank, SBI, IndusInd Bank, and Axis Bank. The reason for this is fairly straightforward. Credit Suisse has made several risky bets and ended up losing a lot of investor money. For instance, Credit Suisse directed many customers to invest as much as $10 billion in Greensill Capital. Greensill was itself a lender of sorts that intermediated between suppliers and clients. In other words, it paid suppliers upfront cash and took their place in waiting for the clients to pay. The business attracted a lot of attention and money, thanks to banks such as Credit Suisse. After several controversies, Greensill went bankrupt in March 2021, denting Credit Suisse and its rich investors of up to $3 billion. Another unfortunate investment was in Archegos Capital Management, which was a family office that managed the personal assets of Bill Hwang. It also collapsed in March 2021, and Credit Suisse lost another $5.5 billion. Incidents such as these have hurt its profitability and eroded investor confidence, which means difficulty in getting more clients and getting more money from the existing clients. In addition, such losses were punctuated by high-profile managerial malpractices and exits, further undermining investor confidence. In the last 5 years, it has changed 3 of its CEOs, which is a red flag in itself. Now, you might realize that the success of the bank depends majorly on the trust that clients have, since the bank deals with their money. And such high-profile losses coupled with the red flags over mismanagement do not sit well with the clients. Credit Suisse, therefore, is an obvious crisis. But what started the discussion now? The most recent trigger seems to be a letter written to the CEO of Credit Suisse to its employees. Although the letter was aimed at reassuring the staff that the bank has a strong capital base and liquidity position, it acknowledged that the bank was facing a critical moment, which was not taken well by the shareholders and led to sell-off of its shares. Consequently, this resulted in the rise of credit default swap rates on its bonds. A CDS, or credit default swap, is like an insurance contract that pays out the holder if a bond issuer defaults on a bond repayment. It's called a swap because the CDS buyer swaps the risk with the seller of the contract. You may recall hearing Michael Burry use them in the movie The Big Short. The CDS are generally traded by institutional investors rather than retail investors. The concept of CDS can be best understood with an example. Say you invested $1 million with Credit Suisse by buying its bonds. In return, Credit Suisse agrees to pay an 8% rate of interest per annum. But what if Credit Suisse goes bankrupt and can't pay even your $1 million, let alone the interest? So, to be safe, you go to an insurer of sorts that agrees to pay you if Credit Suisse defaults on its payment within 5 years. And for this facility, it charges you 2%. So your net returns are only 6%, but at least you are secured from the default. This facility is called the 5-year CDS. Similarly, there can also be a 1-year CDS. Usually the 1-year CDS rates are lower than the 5-year CDS rates, as the odds of the default within 1 year are lesser than in 5 years in normal circumstances. Credit Suisse, however, is not in normal circumstances. The credit default swaps on Credit Suisse bonds rose sharply in a matter of days. While it doesn't affect Credit Suisse directly, it signifies the deteriorating perceptions of creditworthiness of Credit Suisse. The cost to insure the bank's debt using 5-year credit default swaps rose to its highest level in years. It cost investors more than 300 basis points, which is more than 3% of exposure, while the cost for 1-year credit insurance is even more than 4%. This means that the likelihood of a default happening sooner is more than later. These indicators have made people wonder if Credit Suisse will fail. And if so, will it take others with it, leading to a global financial crisis? You see, bank defaults don't only affect the bank's own creditors. If banks default on loans to other banks, it can affect their solvency too and create a domino effect throughout the banking system. So while it may seem like Credit Suisse's problem, it may be ours too. Because when a big bank fails, it can take down others with it. The most recent instance was the global financial meltdown in 2008, which claimed the 4th biggest bank in the US, Lehman Brothers, and with it several other banks and institutions. And most importantly, people's money. So is this a Credit Suisse Lehman movement? Well, not necessarily. The 2008 crisis resulted from an industry-wide issue. The failure of the Lehman Brothers was only a trigger that became an epic rolling disaster in the banking system. In simple terms, all the banks were so sure that the real estate prices will be ever rising, they started giving out house mortgages to subprime borrowers. That is, people who did not fulfill the risk management criteria of the banks. And when large amounts of loans defaulted as borrowers couldn't pay up, almost all the banks went through a severe liquidity crunch. The liquidity drain was so deadly because too many banks were too reliant on short-term financing. So since the global financial crisis of 2008, governments have made it mandatory for banks to comply with strict capital adequacy requirements. If that seems technical mumbo-jumbo, don't worry, it's a lot easier than it sounds. Most investors can reassure themselves about the differences between 2008 and today by reviewing a single page in banks' annual reports, their ordinary balance sheets, and specifically their liabilities. Just compare the proportion of long-term debt and deposit funding currently with 2007. For example, at Credit Suisse, long-term debt, which can't be quickly pulled away from the bank, accounts for 22% of its funding versus 12% in 2007. Deposits make up 53% of its funding versus 25% in 2007. Deposits, of course, can be withdrawn in the worst-case scenarios. However, Credit Suisse demand deposits, the kind that can be most easily taken back, are just 26% of its funding presently. At the other end of the scale, less stable funding such as short-term borrowing from banks and markets plus trading liabilities account for 13.5% of Credit Suisse funding today compared with 44% in 2007. Now, look at Lehman Brothers' balance sheet in its 2007 annual report. It didn't have deposits because it wasn't a US Federal Reserve regulated bank. However, Lehman did have a bit of short-term borrowings from other banks and markets, plus trading liabilities and other money it owed clients, and these added up to 77% of its funding base. Long-term debt was just 18%. Lehman Brothers was more vulnerable to liquidity losses than Credit Suisse was in 2007. Let alone than Credit Suisse is today. To be absolutely clear though, really bad managers could still blow up a bank today. The regulation cannot make banks foolproof. Poor executives could choose terrible assets, fail to understand or manage risks, or lose the faith of their staff and their clients. Yet the banking industry has been forced to change its balance sheets and funding sources in ways that make it much harder for a bank to blow up in a really fast and chaotic fashion. What do you think of Credit Suisse troubles now? Will it survive or will it fail? And in case of failure, will it bring another financial crisis? We'd love to hear your thoughts in the comments. And if you are curious to learn more finance topics in depth in a fun and simple way, subscribe to this channel and make sure you check out interesting financial courses on our website. If you enjoyed this video, please like it to show your appreciation for our efforts and consider subscribing so you don't miss out on our next explainer video on finance. See you in the next video. Take care.